One loss, then five. That's the pattern that quietly ends more trading accounts than any crash, any bad earnings report, any surprise Fed decision. And here's the uncomfortable part. The market didn't take that money. The trades you made after the first loss did. Quick note before we go deeper, this is educational commentary, not personalized financial advice. I'm going to show you the mechanism behind revenge trading, why it's a math problem before it's an emotion problem, and the exact circuit breaker discipline traders use to stop the spiral. This matters right now because volatility regimes reward this trap. In fast, choppy sessions, the kind SPY and QQQ have handed us again and again, you get more losing trades clustered together. More clusters mean more chances to tilt. And with zero-commission apps and one-tap reentry, the gap between feeling a loss and placing the next trade has collapsed to about 2 seconds. That's not enough time for your rational brain to catch up. Now let's name the wrong belief because almost every trader holds it. Most people think revenge trading is a discipline flaw, that they just need more willpower to stay calm, to not be emotional. So they try harder to feel calm, and it fails, because the real damage isn't your mood, it's the size. After a loss, you don't just take another trade, you take a bigger one to win the money back faster. That single change is what turns a survivable day into a blown account. Here's the mechanism. Doubling your size to recover doesn't change your edge. If your win rate and payoff were mediocre before the loss, they're exactly the same on the next trade. All you've done is multiply the amount at risk. You haven't raised your expected value, you've raised your variance. And higher variance around a flat or negative edge doesn't help you recover. It just widens the range of outcomes, and the fat left tail is where accounts die. Let's make it concrete with the simplest case. Say you have a $10,000 account and you risk 1% per trade, $100. You lose. You're down to $9,900. Annoying, but nothing. Now the tilt kicks in, you want it back this trade, so you risk 400. You lose again, down 800 more when you add it up. So you go to 800, then 1,200, chasing the whole. 5 losing trades that started at $100 of risk now total roughly $3,300. You've lost a third of the account in an afternoon, not because you were wrong 5 times, but because you sized like each trade had to be the last. Compare that to the trader who never escalated. 5 straight losses at a flat $100 each is $500, 5%. Painful, recoverable, forgotten by next week. Same 5 losing trades, same market. The only difference is the sizing decision made in the heat after each loss. That's the whole game. The escalation is the account killer, not the losing streak itself. There's a second-order effect that makes it worse. A loss doesn't just make you want to size up, it degrades the quality of every decision that follows. Studies on loss aversion show we feel a loss roughly twice as hard as an equivalent gain. Under that sting, your time horizon shrinks to the next candle, you stop waiting for your setup, and you take trades you'd have laughed at an hour earlier. So it's a double hit, bigger size on lower quality trades. Your edge doesn't just stay flat, it goes negative right when your risk is peaking. And underneath all of it is the break-even reflex. Your brain treats the original loss as a debt the market owes you personally. It doesn't. The market has no memory of your entry price. That losing trade is a sunk cost, the money is already gone. Trying to win it back on the very next trade is like insisting the coin owes you a heads because it just landed tails. The coin doesn't know. The chart doesn't know. Only you are keeping score, and the scoreboard is exactly what's making you reckless. So here's the aha. You don't blow up from being wrong. You blow up from the trade you take to stop feeling wrong. Sit with that. The loss is never the threat. The reaction to the loss is. Which means the fix isn't better predictions or more willpower, it's a rule that fires automatically before your tilted brain gets a vote. That's the circuit breaker professional desks actually use. It's called a daily max loss. Before the session starts, while you're calm, you decide the single number that ends your day. A common version, if you lose 2 or 3 times your normal per trade risk, you're done. Screens off. No exceptions, no one more. On our example account, that's a hard stop at around $300, not $3,000. The rule isn't there to make you money on your best day. It's there to cap the damage on your worst one, when your judgment is least trustworthy. 2 upgrades make it bulletproof. First, add a cooldown. After any single loss that stings, step away for a fixed window, 10 minutes, a walk, anything that breaks the 2-second reentry loop. You're inserting time between the feeling and the finger. Second, pre-commit in writing and ideally make it physical, set a platform loss limit, or hand the login to a partner for the rest of the day. A rule you can override in a tilted state isn't a rule. The pros don't trust their future selves either. They just build the cage before the animal shows up. and this transfers far beyond day trading. The same spiral runs a swing trader who averages down into a falling position to avoid booking a loss. It runs the investor who doubles down to lower the cost basis on a thesis that's already broken. It even runs the poker player, the gambler, the founder throwing good money after bad. Anytime you increase your bet because you're behind rather than because the odds improved, that's revenge trading wearing a different outfit. The circuit breaker logic works everywhere. Decide your stopping rule while you're calm and make it automatic. So here's the disciplined move. Your edge, if you have one, only pays out over hundreds of trades at consistent size. The single fastest way to guarantee you never get there is to size up after a loss. Protect the streak of surviving, not the ego of being right today. Write your daily max loss down before tomorrow's open and treat it like a smoke alarm, annoying, and the one thing that saves the house. If this way of thinking about risk is useful to you, subscribe. We break down the market in signal, not hype. The market didn't take your money, the trade after did. Don't give it the chance.